Hi, this is Professor Cataldo, and this PowerPoint slide, these slides are designed to describe the basic accounting equation and components through basic financial statement preparation. They're designed for someone taking an introductory financial accounting course. Probably this material would be covered in the first two chapters. This is the basic accounting equation at the top. Assets equal liabilities plus owner's equity. Some textbooks just say equity. In Great Britain, the United Kingdom, they refer to liabilities and owner's equity in a combined form as equities. So they say assets equal equities. On the left-hand side, you have the assets. On the right-hand side, you have the liabilities and equity. Starting at the top on the left-hand side with assets, you have cash. Following that, note receivable and account receivable. I have some arrows here. I want you to notice that assets, which are things that you own, are all receivables are assets. Always. If you see an account title, it says receivable, it's an asset. On the right-hand side, notice liabilities, things you owe. Anything with a payable is a liability. Notes payable, accounts payable, wages payable, taxes payable. Again, to the left side. Cash, notes receivable, accounts receivable, store supplies. Some textbooks introduce store supplies as store supplies inventory. They are inventory and they are inventoriable. That's something you own. Land is something you own. Buildings is something you own. Vehicles and equipment. All of these are assets. I've organized these assets in order of liquidity. Far right-hand side, liabilities, once again, notes payable, accounts payable, wages payable, taxes payable. Anything that is payable is a liability. Below that is equity, contributed capital. That is the common stock or preferred stock, the capital initially contributed to form the corporation, and or if there are additional needs for capital, additional shares might be issued. Retained earnings, below that is the earnings that you retain or the earnings net of the dividends, and we'll get to that in just a moment in the next slide. So the basic equation, assets equal liabilities plus owner's equity, A equals L plus OE. This would probably be introduced in Chapter 2 of an introductory financial accounting textbook. Once again, I have the assets on the left. There's the basic accounting equation. I've modified this slightly. I've organized the assets section with a little bit of a break. Those assets in the top are fairly liquid. Those are current assets. We'll get to that later. And the assets below the break, land, buildings, vehicles, equipment, those are long-lived or fixed assets, sometimes referred to as property, plant, and equipment. We'll get to that later. The right-hand side is the same except in the equity section. Again, this is usually introduced in a second chapter of an introductory financial accounting textbook. Instead of contributed capital, I am now going to call contributed capital common stock. It could be preferred stock as well, but if you only have one class of stock, it is common stock. Equity is increased when the firm sells common stock. It's also increased by revenues. It's decreased by expenses. Revenues minus expenses are going to give me net income or net loss. Let's just assume net income. So revenues minus expenses gives me net income. And I might pay out some of that income in the form of dividends. So dividends would reduce equity. Now the revenues minus the expenses minus the dividends are going to result in the earnings that I retain. So revenue minus expense equals earnings. I pay out some of those earnings and dividends, and I retain the remainder of the earnings. Again, this is a framework that might be used in the second chapter of an introductory financial accounting textbook. Now I'm going to focus on the flow of information through the different financial statements. These are three of the financial statements. I'm not going to cover the statement of cash flows. That's a fourth financial statement. And we'll start from the left and we'll go to the right. So here's an example where a firm for the month ended December 31, that's a period of time, had revenues of $3,000, expenses of $800, and net income of $2,200. Let's assume this is the first month of operations. Right below that is a statement of retained earnings. Again, a statement for a period of time. If we assume this is the first month of operations, retained earnings at the beginning of the period was 0. There's my net income of $2,200. Notice how it flows from the income statement into the statement of retained earnings. Let's assume I paid out $500 of those earnings in dividends, and I retained $1,700 of the earnings for that period. So income statement, period of time. Statement of retained earnings, period of time. Now I'm going to move over to the balance sheet on the right-hand side, and I have the arrows. Notice how the $1,700 of retained earnings flows into the balance sheet. Notice also the balance sheet is a snapshot. It's for a period, a point in time rather. On the left-hand side, I have assets. On the right-hand side, I have liabilities and equity. There's that basic accounting equation. Assets equal liabilities plus equity. A equals L plus OE. This is very mechanical. What you want to do is pay attention to the flow of information, financial information, and the very mechanical nature of these financial statements. So I have my assets of $26,900, and they equal my liabilities and equity of $26,900 for the balance sheet, which is for a point in time. Thank you.